All right, so good evening and welcome to this masterclass today for the corporate reporting and financial reporting as we, spend some time to answer any questions you might be having and also share some thoughts on some few things that you have to be mindful of as you walk into the exam hall tomorrow 9 a.m. for financial reporting or 2 p.m. for corporate reporting students. So any questions for me, something specific that you want to ask me about? Those of you on the Zoom, you can raise your hand, I'll bring you up, or you put it in the comment section for me. Any questions, something specific that you want to ask me about? Not like, hey, Nhyira, about this time, not something full, because we are limited on time today. So any specific question, something that you want to pick my brain on, you can raise your hand, I'll bring you up, or you put it in the chat for me. Across all the 5 areas that we're going to be having questions from: consolidated financial statement, the accounting standards, single entity financial statement for financial reporting students, specialized transactions for corporate reporting students, evaluation of financial statements, which is performance measurement in the 2 areas, then certainly governance, sustainability, integrated reporting, and also some IT issues that we have to be mindful of as we walk into the exam or on the theories side of things. So any questions for me? Give me a moment. Let me see if I can pull this up as well here. Please, can you share like live chat for me? Yeah. Okay, so let me then see what the heck we can do some walkthroughs, and then we will be out of here in the next few minutes in that case. And so in the exam hall, one of the core areas that the examiner is going to be getting excited about is the evaluation of financial statements that we need to be mindful of. And so we have spent time to look at everything that we need to understand when it comes to evaluation of financial statements. And we have mentioned that it depends on the type of question that the examiner will want to throw at us in the exam hall. But when it comes to evaluation of financial statement, there are 6 areas or 6 types of questions that we can see corporate reporting students, generally if we are inclusive in that particular case. And so we said the examiner can present us with just a basic financial statement for us to calculate the ratios and then analyze. So simple financial statement, no footnotes. You are just calculating the ratios and then evaluate the performance of the company. Nothing more, nothing less. That's the first type of question. And in that type of question, it is very simple, sweet, straight to the point. The examiner may ask us to calculate certain ratios, but if the examiner is quiet on the ratios you are supposed to calculate and we are just supposed to write a report or analyze the performance of the entity, then you have to decide how many ratios you are going to be calculating. So in such, quiet environments like that, it is important that under the profitability ratios, you may be interested in looking at the revenue issues, right? So asset turnover ratio, pretty important there. Okay. Then net profit margin. So you can skip the gross profit margin and talk about net profit margin, because if you remember, in the interpretation of the net profit margin, you're going to be making reference to cost of sales anyways. So if the question is quiet, in that case, then you want to do asset turnover or the changes in the revenue. in that regard. Then net profit margin. Then certainly you go to ROCE, return on capital employed, or ROE, which is return on equity. All right. Now, the difference between the two is that ROE, that is return on equity, is looking at the returns on the equity shareholders, the returns for the equity shareholders. So that one, you are looking at how much returns the equity providers of finance are getting. That is ROE. But ROCE is where you are looking at the returns on the finance of both the equity and then the long-term debt capital providers in that particular case. So that is the difference between the two. ROE, you are looking at the equity shareholders only in the workflow, whilst the ROCE, you are looking at both equity shareholders as well as the debt holders or bond holders in that particular case. So if the question is quiet, then certainly under the profitability ratios, we're going to be going for these three, because we need to know how the entity is utilizing assets in generating its revenues, which is the asset turnover ratio, right? Then we need to also understand. Now, remember something that we mentioned about the asset turnover, that sometimes we will calculate the asset turnover if we are supposed to calculate it, and you realize that, oh, maybe for the 2 periods under review or the 2 years under review, what we are saying is that the change is not that dramatic. So probably you are seeing like 1.1 times and then 1.2 times. Okay, or maybe 1.1 times and 10 or 11 times. So you see that in this case, it is not really showing us how the entity's revenue is changing. And so when the results is close like this, all right, the difference is really close like this, what you want to do rather is to use the percentage of change in the revenue, right? So although, yes, you've calculated the asset turnover, look at the percentage difference in the revenue. How many percentage increase has come up in the revenue? Then that can become a guide for you to then interpret your net profit margin and then come to return on capital employed or the ROE, depending on what the heck we are doing at the end of the day. And so under profitability ratios, these are the things you must understand. Now, remember the concept of capital allowance calculation. Sorry, not capital allowance. Capital employed. Capital allowance is taxation. So capital employed calculation. Remember, there are 2 ways it could be calculated. Always pay attention to how the examiner is asking you to calculate it. If the examiner is quiet, then you can choose whatever you want to choose from the 2 methods of calculating the capital employed. Either you are going for total assets, right, minus current liabilities, okay, less current liability, or you are going with the shareholders fund plus long-term debt. Okay, if the question is quiet, either formula will give us the same answer. But sometimes the examiner will be specific as to how you are supposed to calculate the capital employed. If he is specific, so you pay attention to the ratio he's asking you to calculate. In brackets, sometimes he tells you the formula. And so whatever formula the examiner asks you, then you have to use that formula in your calculation generally when it comes to calculating the capital employed, because it is important you understand and know the formula. Because if there's a formula you are supposed to use and you don't use that formula, au revoir mon ami, your ratio is toasted. All right, and during our class discussion, some of you fell victim to this or were victim of this. So you want to be mindful of the context of the question, what the examiner is asking you, what the examiner is saying in the question, in the calculation of the capital employed. But you got to understand also that when there is lease obligations in the question, then both the current and the non-current lease obligation must be included in the calculation of the capital employed. That's very important there. So be mindful of that when there is lease obligations, both the current and the non-current lease obligation will be included in the determination of the capital employed, which then means that the capital employed you will use to calculate ROSI and then gearing will be different from the capital employed you use to calculate the asset turnover ratio. Again, you don't have to sweat it because it will be stated in the exam what you are supposed to do. But that is something you need to understand when it comes to this issue, because in the calculating of the gearing, and then in some cases, asset turnover, the examiner will say you should use the capital employed that includes the lease obligation, so that in your ROSI, you will use the normal capital employed. Or sometimes, ROSI and gearing, you will use the capital employed that is inclusive of the lease obligation, and then the asset turnover, you use the normal capital employed, which is total asset minus liabilities. So always pay attention to the context of the question. These are not generic things you make up. It is the context of the question and how it has been stated in the question that you have to be mindful of. So again, as I say always, you're not just walking into the exam hall blindfolded and just doing things anyhow. No. The context of the question is going to guide you in some cases on how you should calculate some ratios. Even the asset turnover thing, the examiner can say calculate total asset turnover, which means that yes, you are still doing turnover though, but instead of total revenue, which you know, okay, so you know your AT, asset turnover, is rev divided by capital employed, isn't it? But the examiner can say calculate total asset turnover, not net asset turnover. So if the question is total asset turnover, that means your asset turnover is going to be revenue divided by total asset. So in this case, you are looking at the revenue that the entity is generating from the utilization of the total assets at its disposal. So again, context of the question, because if the examiner says calculate total asset turnover and you go and do the normal formula, revenue over capital employed, au revoir mon ami, for the calculation, then certainly your analysis, kiss it goodbye. It's gone. It's gone. So again, you want to be mindful. You stay alert to the context of the question. What the heck is the examiner asking based on the context of the question? And that will guide you in respect of what you are supposed to do. But if the question is quiet, profitability ratios, these are the three things that we are going in for. Then suddenly you come to your liquidity ratios, right? There you have your quick ratio and then current ratio in that case. So you could calculate the two, or because the question is quiet, you can go straight to the quick ratio and calculate the quick ratio, because you know that the determination of the liquidity position of the entity is truly seen using the quick ratio or the acid test ratio. And so to avoid duplicity of the explanation that you're going to be making, cut to the chase and come to the quick ratio if there is inventory there. Because again, you have to be careful. We don't know the industry that the examiner will come for you from in the question, but the examiner can come from anywhere. It can come from any industry. It could be a manufacturing company. It could be a retail company. It could be whatever the heck, whatever, a service organization or whatever. So the industry, we don't know. So you have to be mindful of the context of the question. If we can see inventory on the face of the financial statement, then certainly quick ratio has to be calculated. But if we can't see inventory or the inventory is not significant, then you go with your normal current ratio calculation, current asset over current liability, boom, boom, boom. Then you go away in that particular case, which means that when it comes to the working capital ratios, okay, or the efficiency ratios, it will also depend on what is available in the question. If there is no inventory on the face of the financial position, then you cannot calculate anything to determine the efficiency of the inventory management system of the organization. So you can calculate either inventory turnover, how quickly the entity sells its inventories, which is cost of sales over inventory, and the answer is in times. The higher, the better. Or inventory turnover over period, which is how long the entity holds inventory before they are sold, which is your inventory over cost of sales times 365, and that is going to be the lower, the better at the end of the day. And so when it comes to the inventory thing, you know there are two things. It depends on where we are coming from and how we interpret it generally. But either of the two concepts are all looking at how long or what is the efficiency of the entity's working capital management when it comes to its inventories. And so if the examiner is quiet and there is no inventory on the face of the financial statement, then certainly you can't calculate any inventory turnover. Then your trade receivable, trade payable. Again, it will depend on the context of the question. If you don't see receivables, then you can't calculate trade receivable days. If you don't see payables, then you can't calculate trade payable days as well in that particular case. So those will be the efficiency ratios. But, this guy is definitely going to be there. The gearing ratios, three things you are doing, as you remember always. We are looking at the nature of the capital structure of the entity. You are looking at the financial risks that the entity is exposed to. And then you are looking at the ability of the entity to be able to raise additional debt finance in the future. That's what you are looking at here. And there are two ways we can do this. Either we are using debt over equity. Okay. Either we are using debt over equity, or you are using the debt over the capital employed, which is equity plus shareholders fund as well in that particular case. So it depends on the context of the question and also what is applicable at the end of the day. But that is what we need to understand when it comes to the gearing ratios as well. Remember, anytime we are talking about the gearing ratio, definitely its associate must come, which is what? The interest cover ratio, right? So we must bring in the interest cover ratio, which is going to be talking about how many times our profit before interest and tax is able to cover our interest. And we expect this ratio to be, rising, to be greater, anything in excess of 2, we can say that the entity is effectively utilizing its debt, and the entity may not be exposed to any financial risks, and they could raise additional debt finance in the future, although we may calculate a gearing ratio which may be in excess of 60, 70 or whatever the heck. But that is the idea also about the gearing ratio. We'll definitely have to calculate these two here. Then again, if the question is quiet, then you have to decide, can you calculate some investors ratios? Then you go with the investors ratios: earnings per share, dividend per share, PE ratio, all right, dividend yield, earnings yield. Again, all these will depend on the context of the question. There are questions where the examiner will ask you what ratios he wants you to calculate. Other times, if the question is quiet, that's where your discretion has to come in. And that is what I'm talking about. So if the question is quiet, profitability, we are hitting three things there. Then under the working capital situation and liquidity, you go straight up to quick ratio if it is possible. Then as much as possible, inventory, receivable, trade payable, which one you can calculate reasonably. Then you come to your gearing ratio if the entity is geared. Because remember, sometimes we can have a question and there is no long-term debt there, which means the entity has no debt. So if the entity has no debt, what the heck are you calculating the gearing ratio for? There is no debt, right? So you can't calculate gearing ratio because the entity has no debt. It's fully equity finance, which then means that under the profitability ratio, you are going to be calculating ROE, return on equity, because there's no debt, because the capital of the entity is purely equity than debt. Again, I'm just saying some of these things because of the context of the question. And as I tell you all the time, have some understanding, but don't walk into the exam hall with any preconceived agenda. Otherwise, your agenda will agent. So you want to make sure that, yes, understand everything, the formulas, the concepts, the way to do the interpretation. Name what you must do in the exam hall would depend on the context of the question. So that if the examiner asks you to do A, you don't go and say, this is what I learned, so B, there be. You have to be careful. So when you hear asset turnover calculation, you got to be careful. Is there anything in brackets giving me guidelines on whether I should do total asset turnover or net asset turnover or what? Because these are the things which students neglect or ignore, and you are coming home with Zokbo on that area. Because, hey, if you screw up the ratios, what are you writing in the analysis? That's already toasted, right? That's already toasted. And so that is the first style or type of question that we could have in the exam hall. The second type is where the ratio has been calculated already for the entity year on year, and you're just writing analysis, period. Okay, so maybe the same entity year on year or the entity and industry average. That's easy peasy. 15 marks. You are writing analysis. Boom, boom, boom. Hit it up and go away. That's the second type of question. Purely analysis for the 15 marks. The third type of question is the vertical or the common size analysis, which is exclusive usually to the corporate reporting students. And you're going to be doing that where the financial statements are expressed in percentages, and you are supposed to write the analysis on those things in the financial statement. The fourth thing is when there is a change in business or operations, right? So during the year, the entity disposes of a segment of the business. How do we deal with such ratio questions? During the year, the entity acquired a subsidiary. What does that mean? It means the previous year financial statement is a single entity financial statement, but the current year financial statement is a consolidated financial statement. So what are the necessary adjustments that must be done? How do we even write out our analysis? These are all the key things that you must understand, again, based on the context of the question. Then certainly you will come to a question with footnote, which you have to do adjustments before you even calculate the ratios. So this one is a 3-layer base. The number 4 and number 5 are all 3 layers. You have to make some adjustment to the financial statement based on the notes given, and then 2, recalculate the ratios. Number 3, now analyze the ratios. What does that mean? You screw up the adjustment, forget yourself. You walking away with Zokbo. So again, you got to be mindful of the way you got to do the adjustment, what you are going to be taking into consideration and all that. And you remember we solved a question like that, a hidden question during our revision session to give you an idea about some of those things. And in our main class also, we solved a question like that, and you saw what is supposed to be done there. Then the last thing is going to be the cash flow analysis. This is also exclusive to the corporate reporting students, the cash flow analysis, where you are going to be preparing your, not preparing anything, though cash flow is going to be given to you. Then you write out the analysis. So tomorrow, as you go into the exam hall, these are the areas of questions that the examiner is going to be coming in from. And before you walk into that exam hall, 9 a.m. for financial reporting students, 2 p.m. for corporate reporting students, you want to make sure that you have an idea of all of these styles of questions to increase your chances of passing the examination. This, you cannot screw it up. Now, we also have shared with you some guidelines on the way you make certain adjustments and then how you analyze the financial statement. For instance, the change in business situation. If there is a question like that, so during the year they dispose of a segment of the business, what adjustments must you do what adjustments must you make to the financial statement, and how do you proceed with the interpretation? So we gave you the guidelines on this. If there was an acquisition, how do you handle that? We gave you guidelines on this. Then generically, vertical analysis, that's also there for the corporate reporting students, how you're supposed to deal with this. Then the general principles on how you interpret some of the key ratios. The general principles on how you interpret some of the key ratios. That is very important. Again, if you are comparing two different entities, or the entity and the industry average, or the entity with another entity, please don't go and say anything like, oh, the ratio is rising, the ratio has increased, the ratio has decreased. There be. You can't compare two different things and come and say one is, come and say it is increasing. You can't do that. So the choice of words for describing what is happening is crucial. If it is the same entity year on year, that one we know we can do increase, decrease, and we will be good, right? But if we are dealing with the entity and an industry average, you're not going to do any increasing, decreasing, rising like the sunshine, falling like the mango. You cannot do that. It's not possible. So please, that's going to be important there. And you know the way you are supposed to do your analysis already. So if you're interpreting the profitability ratios, as always, start from the top, the revenue. How is the revenue changing? Asset turnover ratio. Okay. Hit us with gross profit. How is cost of sales doing? Hit us with net profit. How is operating expenses doing? Hit us with ROSI or ROI. How is our profitability doing? And so when you build it up like that, it prevents you from making contradictory statements. And I want you to also be conscious when you are writing. Because one of the things that I have also seen is that some of you are not conscious when you are writing. Now, when I say consciousness, what I mean is that you had said something earlier in your own analysis. Then you come down, then you come and say something contrary to what you had said earlier. So it's like you are out of touch of your own analysis. That is what I mean by being conscious of yourself, of what you are writing. Because maybe the gross profit margin has increased. All right. Then he said, oh, the gross profit margin has increased because the entity's cost of sales is not rising as much as the revenue is rising. Okay. Then you come to net profit margin and the net profit margin is reducing. Then he said, oh, the net profit margin may be reducing because the entity's cost of sales is increasing than it is supposed. Bruh. Didn't you earlier say that cost of sales was reducing? That was why gross profit went up. Now you are saying cost of sales is increasing again. That's tautology. Absolute garbage. All right? So be conscious. Because you see, some of these errors, you commit them without even knowing. And you get zokbo at the end of the day. So you need to be mindful about the way you write out the analysis. And be careful the reasons you gave for the gross profit margin, the reasons you gave for the net profit margin, the reasons you are giving for the ROSI. So they are intertwined with each other, not opposed to one another. And that is very important. Then you come to the liquidity ratios. I mean, same idea, the ability of the entity to be able to pay its short-term debt as they fall due at the end of the day. And the guideline is also there on how you deal with the liquidity ratios and how you interpret the liquidity ratios. So you want to be mindful as well on the interpretation. Then the gearing. When you are interpreting the gearing, 3 things you want to show with the examiner in your interpretation of the gearing or the gearing ratio, whatever the heck you want to pronounce. The nature of the capital structure of the entity, the financial risk exposure of the entity, and whether the entity can borrow additional debt finance in the future. Even if you are not asked, you must let the examiner understand that, hey, listen, to really assess the gearing position of the entity, it will be prudent to know the interest cover ratio. So even if you are not supposed to calculate it, if it is possible to calculate it, you can calculate it as one of the additional calculations. So it helps you to interpret the gearing ratio. I hope you are getting the idea, because it enriches the analysis of the gearing ratio. Because the gearing ratio can be whatever we want it to be, or can be whatever figure you are going to be getting. But to determine whether the entity can borrow additional debt finance or not, and also to determine whether the entity is exposed to any financial risk or not, we would have to look at what? The interest cover ratio. So whether you are asked or not, if it is possible to calculate it, that should be part of your calculation. Don't do any calculation on the face of the analysis. Because some of you, some of you go and you do calculation, then you analyze. Calculation, men couldn't say exam. So all your calculations should be as appendix. Sounds good? All your calculations should come in as an appendix. So if you are not supposed to calculate interest cover ratio originally, based on the context of the question, right? But you are interpreting the gearing, and Nhyira said that should be brought in. Don't calculate it on the face of the analysis. Go back and do the calculation, and then come and do the interpretation and connect it with how it relates to the gearing ratio. All right? And we've spoken about this over and over again. So I'm just lashing you for the last time, That's the thing. It's not like I'm trying to disrespect you. But you know yourself that you didn't say munu bebre. Say munu bebre. Some of you don't even know the level of munu you are doing. But I pray for you that you have the wisdom to do the right thing in the exam hall and not screw yourself up. Then certainly the investors ratios, right? I mean, when you're interpreting the investors ratios, broadly, you're going to be making reference to changes in the profit of the entity, right? Because profit of the entity is going to be having an effect on almost all the investors ratio. And then you want to also make reference to the number of equity shares of the entity, right? So that's very important in that particular case. So when it comes to investors ratios also, that is what you are looking at generally. The movement or changes in the profit, the profitability of the entity, that is profit after tax, right? And then also you are looking at the issue in respect of number of shares. Because when the entity has issued some shares during the year, then it's likely to affect earnings per share. It's likely to affect dividend per share, which will then affect earnings yield and dividend yield, which is going to affect your PE ratio at the end of the day. So really, under the investors ratios, we are going to be making reference to at least the profitability of the entity, which is the profit after tax, and then also the number of equity shares. And so if we are then comparing an industry average with the entity or a proxy firm with the entity, it is important we understand the, capital structure of the entities. May not be given, but we have to make some assumptions. Please. The second most important thing in the analysis part is this one. Do not make any definite statement unless it can be confirmed in the question. What does that mean? The gross profit margin has gone up. This is because the entity's cost of sales. Can we confirm it? Is it true? So that if it cannot be confirmed, then you make conditional statement. This may be due to, this may be because. Do you understand it? That is conditional. But if you say this is because, that means you are certain. What if it's a lie? What if it's a lie? Okay, then somebody will say, Nhyira, what if it's the truth? there be giants. No. Don't make any definite statement, right? If we cannot confirm it in the question. So be generic. This may be because, this may be due to, okay, those kind of things. And please, we've already talked about this over and over again. You see, the way you write your analysis, make sure you don't write some Banku English, right? Like, oh, you repeat some phrases. The way you use those prepositions and those other connecting words. Moreover, furthermore, also, in addition, we handled that. For some of you, when we wrote the analysis, don't go screw yourself up. Okay? When you are making a statement or using a word like furthermore, it means you are coming to tell us additional things about what you just said. Also, you are coming to toe the same line. But you can't say furthermore, then you come and say something contrary to what you had said already. Grammatically, you are toasted. And the examiner marks grammar because this is an English paper, not not a tree paper. So please, in addition to the complexities in the calculation part, which you have to deal with based on the context of the question, a banner analysis knows there are some complexities there. And we've walked through some of these things throughout our discussions. Some of you have written the analysis over and over again. You've been guided on what you are supposed to do. Some of you have never written any analysis. For you people, there is nothing I can say. All I can say is, you know you are good. That's why you didn't participate. So whatever you know to do, go and do in the exam hall, and we hope that you'll be able to get a significant marks at the end of the day. Because this thing is not staking lottery. You have to follow a principle. That is why this guideline is here. How do you interpret the profitability ratio? That is why this guideline is here. How do you interpret the gearing ratio? That is why this guideline is here. How do you interpret the investors ratio? This is a 20 marks area. 20. And you can walk away with 0. If you screw up the calculation, forget your analysis. That's very important. The final thing is whatever the heck the examiner will ask you to do. Pro forma. If it is a report, you know you are coming in with what? To, from, subject, date, introduction, please. In the introduction, don't list the ratios. What did we say? List their group that they belong. So if you are using profitability, liquidity, gearing, and investors ratios, that's what you say. That can say using asset turnover ratio, Rosie, then you list all of them. Debbie. Sister, we don't have time for that. Professionally, that is not right. So your intro should be catchy, sweet, simple, straight to the point, bearing in mind the 3 issues. There is an analysis to evaluate the financial performance and position of Nkonko Limited for the year ended 31st December 2024 using the profitability, liquidity, gearing, and investors ratio with other recommendation to improve the performance of the entity. Noko nice, neke. Something nice like this. Either go and write some Banku English. I will knock you in the realms of the spirit there. You will see. So that is report, the pro forma. Then if you are writing just an analysis, right, the examiner says, oh, comment on the performance on the entity or write the analysis of the entity. What do? You bring heading, right? Then your intro comes. Now, the closure is very important. If it is a report, you have a thank you, right? Thank you. Then you have yours sincerely or sincerely yours or yours faithfully. Then you have your signature. Then you have your name. That is if we are doing a report or a memo. But if you are just commenting, when you finish with your conclusion paragraph, you just say thank you. It ends there. Because some of you, when we're doing the assignment in class, even if it is analysis, you are trying to write yours faithfully, then you sign, you write your plenty name there. We are not interested. So the context of the question, right? So that you don't do anything that you are not supposed to do generally. So when it comes to the writing part also for this, that is what we need to understand. As I mentioned, yes, the calculation part, there are little headaches there. We've dealt with some of those things in class. Then the analysis part, the guided line that you have to follow is also there for you to follow. All right. And two other things under this topic, which is objectives of ratio analysis and then the limitations of ratio analysis. Then if you remember, we solved a question in class where somebody was acquiring, all right, an entity was acquiring two other companies. And the question was, what's the limitation of the acquiring firm trying to acquire the company using just the ratios? Okay. Now, the context of that question is different from normal organic limiting factor analysis. Sorry. Normal organic ratio analysis questions. Are you getting it? And we discussed that in class. Those of you who did it, you remember that question. So in addition to the calculation, the analysis, please make sure you read through the objectives or importance of ratio analysis, then the limitations of ratio analysis, paying attention to limitations based on the context of the question, because that could also be pivotal in your ability to pass the examination. So this is that first part area, 20 marks, easy peasy, but you can walk away with 0, like I've told you, if you are not careful. If you are not careful, you can walk away with 0. So please, stay cool, be conscious, look at the question, don't be in hurry, read everything, make sure you understand what you are supposed to do before you take the move. Because there is no turning back. You screw it up, you're going to come back in July. And nobody wants to see your face in July in this paper. So you better do the right thing and pass the exam. So that is a ratio analysis. I'm seeing some comments coming up. Let's see if I can take them. If there is any other specific question also, you can raise your hand. I bring you up under this area here. Let's see, what do I have? Oh, Jefta, you're laughing at me. Eh? Also, the ratio analysis lecture 16 password. What do you mean? The password to access the document is under the place you downloaded the document. This is one of the things I'm talking about. Paying attention. Because where you downloaded the document, there is password to open the document there. It's there. Oh, you didn't see it? It's there. Attention. Attention. Yo. So go back to the video. The password to open the document is under that place where you will download the document. All right, to be able to download it. Okay, so let's see on YouTube, Facebook. Okay, no, I don't have any comments in respect of this that I have to respond to. So that is the first part, ratio analysis, 20 marks, and the various things that we have to be aware of as we go into the exam hall. Now, for corporate reporting students, I mean, those other excesses like vertical or common size analysis, and then certainly cash flow analysis, we discussed that in class. And we asked you to write analysis. I think there were only 2 people who wrote analysis about this. And as I said, you know, it's quite interesting how many of you did not participate in writing the analysis and even involve yourself in this 20 marks area, really, as you are expected to. Because, like I was saying, you can easily walk away with 0. And it is not like I'm saying something negative to you. No. It's because there is nothing in your head on how this thing is supposed to be done. It's not magic. Are you getting it? So, again, you want to make sure that follow this guideline. Yeah, you may not have written any analysis on your own, but follow the guideline. When you get there, we hope that you can write something sensible that can earn you the mark. And that's the reality. You write something off. The people who have been writing the analysis, sometimes they wonder if they were the people who wrote the things that they wrote when we were reviewing some of the scripts. And that is the epiphany that you're going to be having. So in your head, you think you are writing some brofwama. And that's the unfortunate thing. But that's the path you've chosen. So there's nothing I can do about that. I can't do anything about that. All right, so that's ratio analysis, and that is what we must understand there on that one. Okay, so there are no other questions for me on this one. Okay, then we go to the second area, which is what we spent our last session during the revision masterclass to deal with, because we mentioned that there's going to be written questions for 20 marks, okay, in the exam hall. And as per the best practice guidelines, you want to take that first, 20 marks question on the theories, if you remember. For the financial reporting students, permit me to just see if I can push up my slide here, final session. Yep. So for the financial reporting student, we said that the theories that will be there includes the following: ethical issues. So on Friday, you remember we did ethics. We solved a question about ethics to understand how we are supposed to write out our answers. Then we saw the role of the International Accounting Standard Board and the IFRS Foundation, the processes involved in setting standards. We discussed the issue about sustainability and then governance. And then I told you to go read on the conceptual framework and regulatory framework in that particular case. So you want to make sure that as you are going into the exam hall, governance, right? The two key issues that you must know about. What are the governance principles as per the Companies Act 2019, Act 992, then the governance principles enshrined in the governance code issued by the Security and Exchange Commission for listed companies. Then the board structure, the role of the various committees of the board. We went through all of those theories. So please make sure you crystallize on all of those theories that we discussed in this particular document and the various things that you must understand, okay, on the governance side of things. Then we spoke about the actions that the ICAG, and these are the roles of the various committees of the board. I asked you to read that, okay, because it's a reading area. The examiner control that as because it's part of the governance area we are supposed to know about as financial reporting students. And as I mentioned, this transcends to corporate reporting students as well, because everything is in financial reporting is applicable to you. So the governance issues are equally applicable to you in the corporate reporting class there. Then we spoke about, how do we call it? The governance concept. I asked you to read that as well, because these are all theories that the examiner can throw at us on that 20 marks area in that case. So fairness, transparency, independence, honesty or integrity, responsibility. Then the last thing is the actions that the International Accounting Standard Board has taken when it comes to sustainability. All these are theories you want to make sure you go over before tomorrow 9 a.m. again, just to make sure you crystallize some of these things, because the examiner is going to be throwing that at you in the exam hall. Something on governance is going to be there for you, and you have to be mindful you are able to answer that pretty well in that particular case. So The IFRS foundation we discussed, the processes of setting the standards or stages of setting standards. Make sure you go through that again. Ethical issues may or may not be there because there are some examination diets where under the old syllabus, for instance, you go to the exam hall and there is no ethics, right? But it's an important area. That's why we discussed it on Friday. Solve the question on how you are supposed to write out the answers when it comes to ethics. Then certainly the conceptual framework for financial reporting. Please, as I mentioned, this is 15 marks area plus other theories under ratios, and then the theories in what? Consolidation. Right? So I believe that the theories in consolidation too, you've read them, because the examiner can also bring us a 5-mark question from the consolidation area where we are looking at how the entity can gain control. Please, this is applicable also to corporate reporting students, everything here. Number 2, so how can an entity gain control? So the examiner can present a scenario and ask you to state whether the company has control or not, or whether they can consolidate their financial statement or not. So control. Number 2, entities that are exempted from the preparation of consolidated financial statement. So although they have control over another entity, what are the limitations on them on the preparation of consolidated financial statement? We discussed these things. We spoke about the fact that if their shares are not, or their instruments are not listed on the stock exchange. Number 2, they are not preparing to be listed on the stock exchange. Definitely. Number 3, they are an intermediary firm whose financial statement forms part of another entity that prepares financial statements under the IFRS, which is publicly available. And so they are a subsidiary of another company. Then they cannot prepare consolidated financial statements. Then certainly the equity accounting concept for investment in associate, IAS 8, and the discussions that we had there. Then if you remember, when we were looking at the consolidation masterclass, there were some theories we discussed in the very beginning. Let me see if I can get a slide. Joint venture arrangement, IFRS 11. When we started with the consolidation masterclass, these are theory areas and the way things are supposed to be treated. So under IFRS 11, joint arrangement, right? And we spoke about 2 types of joint arrangement: joint operations and then joint ventures. How do you account for those things? These are all areas the examiner could visit, and so you want to make sure that you are familiar with all of these things. It's part of consolidation, and we discussed all of these as well. Don't do your face like, don't make your face like we didn't do it, unless otherwise you were not in the class, neither have you watched the playback. That one you are on your own. I cannot help you. But you want to make sure that those theories there, you be mindful of them generally. Then, as I said, the investment in associate, when we have significant influence, how do you deal with that? That's a theory area. But that could also feature in the preparation of the consolidated financial statement as a whole. So control, indicators of significant influence, exemptions from the preparation of consolidated financial statement, then treatment of negative goodwill, right? If goodwill is negative, how do we treat it? Normally, we expect goodwill to be positive so that it will be carried on the face of the statement of financial position, right? But if goodwill is negative, we said we treat it as profit on acquisition. All right, profit on acquisition. And so if we are preparing consolidated P&L, that will come as a line item on the face of the consolidated profit or loss. If we are preparing consolidated statement of financial position, the negative goodwill will be taken to the group retained earnings so that we can get a retained earning figure that will go on the face of the statement of financial position. Then the last thing is why, or what are some of the reasons why goodwill will be negative? And we spoke about negotiation, right? And then the fact that it's a false sales, right? And the fact that the shareholders of the target firm do not know the value of the company. So all these are theory areas on consolidation that the examiner can throw at us, forming part of that forming part of this session A area of the syllabus for financial reporting students that we must know about. And it's done deal. These theories are going to be there for you. Done deal, waiting for you. Now, as to whether all of them, that I cannot guarantee, but the examiner could choose. There are 5 things here plus the consolidation making 6. And so the examiner has 20 marks from those 6 areas. He can decide to bring 4 of them, 5, 5, 5, 5, 5. For 4 of them, 5, 5, 5. So he can get that 20 marks on the theory area. And as I said, also, you want to make sure you read all the questions and take out these theories as fast as possible before you start getting excited. Because when you start getting excited doing the calculations, you are likely to forget these theories. And as I say always, I mean, you'll be on your way going home, or you are at home after freshening up, then something will whisper into your ears. Oh, Minana, go and take the question paper and see. Go and take it. Go. Then you take the question paper, you flip and realize that, oh, there were a lot of theory questions. I could have answered it, but I didn't answer. And you are toasted. So please, again, it's about strategy. So those are the theory areas, 20 marks. Please make sure you go through them again before you get excited tomorrow as we go into the example. Now, for corporate reporting students, in addition to your knowledge in ethics, in the standard setting, current issues, we also yesterday wrapped up on those other issues: sustainability, integrated reporting, and then the IT areas, right? And you will see questions about these things in the exam. It's an option available to the examiner for you as well. So in addition to the corporate financial reporting situations, you have 3 other layers you have to add to those theories: sustainability reporting, integrated reporting, and then the IT issues. And please make sure that you go through these material again to have the understanding of the various things there, so that when the theories come, you can answer them. All right? You don't want that 20 marks to go scot-free or to go away freely. You can get some, if you're a good student, you read well, maybe you can get 15 out of the 20, or maybe 12 out of the 20. That's great. I mean, it puts you ahead of the curve. Then you can start earning some other marks in the other areas. So when it comes to the theory 20 marks areas, these are the things we have to be mindful of. Please read them. Please. It's a 20 marks area. Don't screw it up. Okay? Please. So that's our second area in that particular case. So ratios, and then these theory areas that we have to be mindful of, because it will come. Now, the reason why I really emphasized on these theories during our last session is because many students from the back end, many students do not really appreciate these areas. So it takes them by surprise, or they don't even pay attention, because some of you, as you are going into the exam hall tomorrow, your mind is conso, sir. But there are theories you could answer. And so that is why I spent the last session, both in financial reporting and corporate reporting, to ensure that we crystallize on these areas very well at the end of the day in that particular case. So make sure you review them as you go into the exam hall, so that when you get there and the grace finds that the things you read, you are remembering them and you are answering them, who knows? You can even get 18 over 20 of the theories, because it's a written area. Unless your grammar is not good, you can't remember the items well, you could get significant portion of that written area before you start dealing with the IFRSs and stints. You see that thing? So it's just a strategy in that particular case that you must know about in that regard. Please, I do not have these are additional materials given to students who have purchased our book on either financial reporting or corporate reporting. So if you bought the book, you can send a message on WhatsApp. Details will be, once it is confirmed, the document will be sent to you. Because it's not a document we are giving out. It's part of our book on financial reporting or corporate reporting. So if you bought the book, you can send a message on WhatsApp, and then it'll be sent to you after it is confirmed or your purchases is confirmed. So that's all about that on the theory side of things. There is nothing here apart from reading and memorizing and being able to recollect. I know some of you are going to do Baba. Baba will not rain. It won't rain. So forget it. Baba doesn't work. Understand the material. Appreciate the material. I know some of you say, oh, Nhyira, I don't know. I do Baba, but I pray for you so that Baba will rain on you. Okay? But that is the theory area that we need to understand as well in that particular case. Then we come to the area that is going to be crucial for our examination, which is the IFRSs, the accounting standards. Directly for financial reporting students, this is minimum of 40, because you have a dedicated 20-mark question on the standards. Then the single entity financial statement also, each of the footnotes, for the most part, will be an accounting standard. So directly 40. Now, we could extrapolate that a little bit, because the examiner could bring a theory question also on one of the accounting standards. And then you will need to have the understanding of the standards, sometimes in ratios, when you have to make certain adjustments. Then the standards will also chase you to consolidated financial statements, when you have to deal with fair value adjustment and some other footnotes in the consolidated financial statement. So last semester, for instance, as we share with you, 70% of the questions required that students call on accounting standards. And so, be strong in the ratios. Be strong in the theory areas that I have reminded you on. But you got to be equally strong on the accounting standards. As I've told you already, and you know this already, we are going to be having a question on non-current asset accounting standards. So the non-current asset standards, you have to know them very well, because whether I like it or not, you're going to be applying them, either dedicated question, or you apply them in consolidation, or you apply them in single entity, or you apply them in specialized transactions, business valuation, or you apply them in, ratio analysis, something. And this includes those guys, the issue about IAS 16, right? Property, plant, and equipment. His brother, IAS 40, investment property. Coming into IAS 37, provisions, contingent liabilities, contingent assets. Then IFRS 5, non-current asset held for sale and discontinued operations. Pretty important there. We need to understand it in that particular case. So these non-current asset accounting standards, very important. They are going to be the bedrock running through. So either we'll have a dedicated question on them, hallelujah, or their principles will be called on somewhere. So these standards, as you sit right now, do you understand everything about these guys? IAS 16, the key takeaway will be what? Initial measurement. The initial cost of the asset shall be the purchases cost plus all other directly attributable costs incurred in bringing the asset to its present use. On subsequent measurement, what the heck do we do? It could be carried at a cost model or the revaluation model. Okay. If we revalue the asset for the first time and it is a loss, then the revaluation loss will go to P&L. If we revalue the asset for the first time and it is a gain, then the revaluation gain will come to OCI. Then on the face of the statement of financial position 2, we will have revaluation surplus there. However, if we are dealing with subsequent revaluations, which means last year the asset suffered an impairment, but when it is revalued this year, it is having a gain. Then in that case, the gain must be recognized in the P&L accounts equivalent to the loss that was recognized in the previous year. So that the excess is what will come in the OCI and also go to the revaluation surplus. 2, if we are doing subsequent revaluation and the asset is suffering an impairment in the current year, but last year it was having a surplus, then the impairment for the current year will be recognized in the OCI and subtracted from the revaluation surplus, equivalent to the amount of the revaluation surplus. If the impairment or the revaluation loss is greater than the revaluation surplus relating to that asset, then the difference is what will go to the P&L account. So those are the nuances there that you got to be mindful of. Then you remember also that when assets are revalued, what happens? Depreciation is going to be calculated on the revalued amount. You know that already, right? And when revaluation is also done, you know there is a brother that is likely to come to town. So in these standards, there is a brother that they have, IAS 12, income tax. And this guy, IAS 21, effects of changes in exchange rates. These two standards have connection with these guys that we must understand, especially this. They have some relationship there that we have to be mindful of in that particular case. IAS 40, if you remember, is an investment property. How? Because the asset is held for capital appreciation purposes. Number 2, the entity is undecided on the usage of the asset. Or number 3, the entity is renting out the asset or leasing out the asset under an operating lease. Then that asset can be classified as an investment property. By default, investment properties are carried at fair value. However, where the fair value of the investment property cannot reliably be measured, then it will be carried at the historical cost less accumulated depreciation, which means we may have an investment property, but if the fair value cannot be determined, it will have to be depreciated over the economic useful life of the asset. Then certainly the fair value concept in accordance with IFRS 13. There's a summary video on it on the portal. Please make sure you watch it. It's a basic concept you have to know about as a financial reporting student or corporate reporting student walking into the exam hall. IFRS 16 fair value measurement. There are two things. If we want to determine the fair value of an asset, what do? First, we need to find out, is there a market for the asset? If there is a market for the asset, then we use the value or the fair value of the market, and that is the level 1. Okay? So there is a market for the product. If there is a market for the product, then we can determine the fair value of the asset or the transaction in the market. But remember, when it comes to the markets, there are two types of markets we must know about. We have what we call the principal market and then the most advantageous market. Now, the principal market is the primary market within which that asset is sold or bought. And so where we are dealing with an item and there is a principal market for that item, then we will use the fair value of the item in the principal market to measure the item. But if the item has no principal market, then we're going to use the most advantageous market. The most advantageous market is the market with the largest volume and activity levels, not the market within which the entity in question sells more, but the market within which there are more activity or volumes in total. So if there is no principal market, then we will use the most advantageous market. And if we identify the most advantageous market, the market with the largest volume and level of activities, the fair value of the item will be the selling price less the transaction cost and the transportation cost. And that is what we must understand there on the level 1 issue, where there is a market for what we are selling. If there is no market for what we are selling, you go to level 2. This is where you use the fair value of similar transactions. Fair value of similar transactions, similar assets, to measure the fair value of the item in question. Right? So, for instance, I use this example all the time. You look at Android phones, like say Samsung device and then iPhone. Second-hand market for Android devices, very poor. Right? But there is a lot of second-hand market for iPhones. And so if I have, whatever the heck, Samsung S24 Ultra, and I want to determine the value of Samsung S24 Ultra after 1 year of its usage, we can, and there is no active market for selling Samsung S24 Ultra, that is principle number 1 or level 1. Then I'll come to level 2. Okay, which phone is similar to the Samsung S24 Ultra? Then we can say, okay, let's compare that to iPhone 16 Pro Max. So if the Samsung S24 Ultra is 1 year old, then iPhone 16 Pro Max, not up to 1 year at this time though, but that one too, how much will it be at this time? Then we can use that value to determine the value of the Samsung S24. That is level 2, using the fair value of similar transactions. If that is also not available, then we go to the final level, level 3. This is where you use other information about the asset to determine its value. So for instance, you will be told that, oh, the carrying value of the asset is, say, $10,000. However, the asset can be redeveloped. And when it is redeveloped, the fair value is $700,000, and the redevelopment cost is maybe $120,000. Okay, so the carrying amount is $100,000. However, the asset can be redeveloped. When it is redeveloped, the fair value is $700,000. After we spent $120,000. So how do we measure this asset? Certainly, you won't use the carrying amount. You use the fair value. And in the level 3, it will be the fair value if we redevelop the asset less the redevelopment cost. So that the fair value will become $580,000, and that will be the value at which the asset will be carried in the books of the entity. And so that is the idea about IFRS 13. It's a basic standard. That is also part of the KG2 standards that work below everything as you are going into the exam hall. So it's a standard that you don't have to worry about. You have to know about it. You don't have a choice. It's not like you have a choice. You have to know about it. So please be mindful of IFRS 13, because it's a baby standard that is going to be walking around, that you have to apply the concept in questions based on the context of the question. All right? So that's about IFRS 13. Then you come to IAS 37. You know you're going to be applying that even in consolidation. When there is a deferred consideration, IAS 37 is coming to town there. We get a present value. Then what do? You unwind. You unwind, right? Then you should know the things that the entity can make provision for, like warranties, like, how do we call it? Like warranties, like onerous contracts, right? Onerous or onerous contract, depending on the school you attended. Onerous contracts, one-time contracts resulting into a loss, we can make provision for them. And then restructuring costs. Remember the principle on restructuring costs. We can only make provision for restructuring costs when there is a detailed plan and it has been announced as at the end of the year. Then we can provide for it in the books. So, and then contingent asset, contingent liability, you got to understand that pretty well. IFRS 5, non-current asset held for sale and discontinued operation. The criteria is sale. Management should decide that they want to sell the asset. The asset should be made available or put in a saleable condition. The entity is looking for buyers, and certainly they expect the transaction to be completed in less than or within 12 months. So these guys, these are basic baby principles. You don't need magic on these guys. You got to know them before you go to the exam or tomorrow, which I know you know already, you know, by the grace of God. You know them already. So if you don't know them too, the summary videos are there to help you. All right. So those are baby standards. Either we will have dedicated questions on them, or their principles will help us to answer other questions. Then we come to the three guys, which we had, interesting time with. IFRS 15, revenue from contract with customers, the first standard we looked at during our session. IFRS 9, financial instrument, and then IFRS 16, leases, generally. I'm not going to be talking really much about these generally in that particular case, but IFRS 9, financial instrument, please be careful. If we are dealing with financial assets, the treatment for a financial asset will depend on the model that the entity is using. If it is a share, then they can carry it at fair value through P&L, which means any transaction cost must be written off in the P&L, or at fair value through OCI, which means any transaction cost must be included in the initial measurement of the financial asset. Then on subsequent measurement, any fair value gain or loss will be carried into either P&L if it is fair value through P&L, or OCI if it is fair value through OCI. So please be mindful of the treatment of transaction cost. If we are in financial asset, either we write it off in the P&L, which means the entity is adopting fair value through P&L, or we include it in the initial measurement of the financial asset, which means the entity is adopting at fair value through OCI. If the question is quiet, you are at liberty to use any of the method. You'll be good. You'll be good. Okay, you'll be good. When it comes to debt instruments, still financial asset, because an entity can buy a debt instrument. It's still a financial asset. And it could also be still carried at fair value through P&L if it is traded on the market. If not, then on subsequent measurement, it will be carried at amortized cost, so that the interest receivable, effective interest receivable, will be recognized in the P&L in that particular case. So that is the issue about financial asset. For financial liability, this is where we hear the entity issued. Okay? The entity issued. The entity sold. So we are preparing the financial statement for the entity that is making the issue, that is making the sales. Then we are dealing with financial liability or equity instrument, depending on whether the entity has an obligation to repay. So if you remember, we mentioned that if the entity has an obligation to repay, then it's a financial liability. If the entity has no obligation to redeem or repay, then it's an equity instrument. Now, if it is a financial liability, then certainly any transaction cost you incur must be subtracted in determining the initial measurement of the financial liability. Because when it comes to financial liability, the initial measurement is the fair value less any transaction cost. So know the way transaction cost is treated when we are in financial liability. Know the way it is treated when we are in financial asset. Always ask yourself, who am I preparing the financial statement for? Is this the person buying or the person selling? Because the examiner can set a bailer trap for you. And this is the bailer trap. The question will read, whatever the heck, My Love Limited issued a debt instrument, whatever the heck, which was acquired by Heartbreak Limited for whatever the heck, $100,000. Then other details will be given. Required. Explain how the above transaction will be recognized in the books of Heartbreak Limited. Okay. So whose books are you in? You are in the books of the buyer. That means it's a financial asset. But if you just follow and say, oh, my love limited issued debt instrument, financial liability, Zokbo. That's why I keep on telling you, hold up, take your time, be conscious, understand the context of the question before you get goosebumps. Very important. Very important. Then certainly the last thing here is IAS 32, my favorite guy. When you hear that the entity has issued convertible loan note. If the entity bought convertible loan note, we don't deal with IAS 32. If the entity is the one issuing, the one raising the investment, and it is a convertible loan note, then we come to IAS 32, financial instrument presentation, which means the convertible loan note that has been issued by the entity must be splitted into what? The debt component and the equity component. How do we get a debt component? By discounting the cash flows, including the redemption amount of the debt, using the effective interest rate or interest rate of similar bonds without conversion right. We solved questions on this during our revision session, and you saw the way the workflow is. Be mindful of that. So that whatever proceeds we got minus the debt component gives us the equity component. On subsequent measurement, if you remember, we carry the debt component using the amortized cost schedule so that the effective interest payable is what goes to the P&L account. The equity will be carried in the statement of financial position and the other component of equity until the date of redemption. So when it comes to IFRS 9, IAS 32, financial instruments, these are the things you must understand. Note, if the entity issued convertible loan note and there is a transaction cost, the way we treat the transaction cost is that after you calculate the debt component and calculate the equity component, now you allocate the transaction cost on a pro rata basis. And so let's say that from the split, you got the debt component to be 10,000, you got the equity component to be 3,000. That's from the splitting workflow. And then your transaction cost is, let's say, 800. You're now going to share. So the total is 13. So you're going to less from the transaction cost, how much? 10,000 over 13,000 times 800. That's what you will less here so that you get the initial measurement for the debt. The equity component will take its share, 3,000 over 13,000 times 800. That will also be less. That's how you get the initial measurement. So when there is a transaction cost on issue of convertible loan notes, that is how you deal with it as well. So that once you get your initial measurement, on subsequent measurement, that debt is carried at the amortized cost schedule in that particular case. So those are the things you must understand under that guy, IFRS 9 financial instrument. It's a very crucial area. You could have it in consolidation. You could have it in the single entity area, or you could have it as a dedicated question on its own, like the convertible loan note. Very, very nice. Okay? Very, very nice. 5 marks or 7 mark question, then it's just smiling at you. And you're supposed to just apply this principle, bum, 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 and you go and get an easy 5 marks. For you. Easy. I'm not saying it's coming. I'm just telling you. Then you come to financial or lease obligations. Lease is IFRS 16. We spoke about this, also solved some questions in respect of this. In lease obligations, you remember we mentioned that we have to, it depends on the context of the question, because an entity can lease an asset, but they may elect to apply the low value model. You remember we spoke about that, right? They may elect to apply the low value model. Let me just show you what the heck I'm talking about from my slide here. Okay, we did this in a corporate reporting class, yeah? Here. So we mentioned that the lessee can apply the low value model, what you see on the far right in that particular case, which means although they've leased the asset, they will treat it as a normal rental. So no need to do any subsequent measurement on the lease, no need to do any split between current and non-current. They are using low value. So the context of the question, if they elect to do that application, then that is what we are going to do. But the default way of treating the lease is certainly to recognize the right of use and then the lease obligation in that case. But the thing that we highlighted on, I don't know if we spoke about it. Yeah, we spoke about it here. The lease payment. I think we highlighted on this pretty well that when it comes to the lease payment, there are two types there. If you remember, we spoke about this in much detail during the class. We have the avoidable lease payments. These are conditional payments embedded in the lease. Then we have unavoidable lease payments. These are non-conditional. And so in the determination of the initial measurement of the lease obligation, the unavoidable lease payments, they will be brought. It will be included in the initial measurement. But the avoidable ones are conditional payments that will make to the lessor if certain conditions are met. So in the year ended under review, if we meet the condition, then we make the payments to the lessor in that particular case, and it will be recognized as an expense in the profit or loss account. And so if you remember, we spoke about this in much detail, discussing that as well, that you must know about in that particular case. So that is the key takeaway when it comes to determination of the lease obligation that you have to be aware of or be mindful of. Then suddenly you come to whatever the heck, their last brother, IFRS 15, revenue from contract with customers, the 5-step framework for revenue recognition. Please make sure you know that pretty well. And if performance obligation goes beyond one accounting year, how we do the treatment: calculate profit or loss on the contract. If it is a loss, we provide for that in the P&L account. If it is a profit, then we have to recognize revenue and profit using percentage of completion. Remember, there are two ways percentage of completion can be calculated: either the input method or the output method. The input method is where we are using cost incurred to date divided by the total contract cost times 100. The output method is where we are using the work certified, right, or value of work done divided by the total contract value times 100. But you got to be careful here. You got to be careful, because if we are using the input method, then in the preparation of the P&L extract, you take percentage of completion of the revenue, then you take percentage of completion of the cost, the total contract cost, so that you get a profit figure. That is if we are doing input method. But if we are doing output method, then you take percentage of completion on the revenue to get your revenue figure. Then you get your profit, which is from the profit of the contract in step 1 of the percentage of completion to get a profit, so that the balancing figure becomes cost of sales. We emphasized on this pretty well. So it is not a blanket approach. In the input method, cost of sales and revenue will be calculated using the percentage of completion. But in the output method, you calculate revenue, calculate profit, so that the balancing figure becomes cost of sales. And that's a key thing I really want you to take and be aware of in that particular case. Then the last thing there will be, the preparation of the statement of financial position. You bring your cost incurred to date, profit recognized, any invoice that has been given to the customer, any cash we receive from the customer, so that we can get the contract asset or liability, which will be recognized on the face of the statement of financial position. Now, if we invoice amounts to the customer and the customer has not paid all of them, then the difference becomes receivables that will also be recognized in the statement of financial position. So these are the things we must understand when it comes to IFRS 15. revenue from contract with customers, the 5-step framework, and then when performance obligation is going beyond one accounting year. So these 3 standards are also crucial. You may go to the exam or maybe one of them will be there. Sometimes all the 3 will be there for you because they are crucial accounting standards that you must know about, right? Very crucial. Just one thing that I missed here under the non-current asset is these 2 guys. Number 5, borrowing cost, IAS 23, okay? And their last brother, IAS 20, government grant. That's it. So remember how we calculate borrowing costs, taking into consideration the capitalization rule, and then when there is an investment income, it has to be subtracted if it is earned during the capitalization period, and then we get a net borrowing cost at the end of the day. Then if we have money coming in from different sources, then we have to use the weighted average interest rate to be able to then calculate the borrowing cost on the project in that particular case. Government grants, knowing the 2 methods that we have to use, the write-off methods, the deferred income approach, knowing that in the deferred income approach, you are going to be splitting the carrying amount into liabilities and non-current liability in that particular case. Then the last thing is grant repayment. Okay, so if there is a repayment of grant, how is it supposed to be dealt with? And we discussed all of these. So you want to make sure, and these are the key issues generally that we have to really take into consideration and look out for in that case. Then under IAS 40, if you remember, we solved a question during the revision session, and I highlighted something to you about the fact that when there is an investment property that is a mixed property, what does that mean? It means that the entity is, using part of the property, and they are also renting part of the property out. So under normal circumstance, the portion they are renting out would be IAS 40. The one that they are using should be IAS 16, property, plant, and equipment. But the applicability of this depends on whether the property can be sold separately. And so in the question we solved during the revision session, it was categorically there that, they could be sold separately. And so we treated the one that they use for the day-to-day running in accordance with IAS 16, and the one that they are renting out, the floors that they are renting out, in accordance with IAS 40. But if the condition is that they cannot be sold separately, then we apply it in accordance with IAS 40. It means the whole property will be carried at fair value in accordance with IAS 40. So that is an add-on principle that you must understand when it comes to IAS 40. Important, because it was something I wanted to highlight really to you. That's why we solved that question during the revision, and I emphasized on that pretty well, because it's something that you could see. An investment property is very simple, but if that condition, you don't pay attention to it, you toast it, and you are walking away with 0 from that marks or from that question. So you have to be mindful of that concept also under IAS 40. Then suddenly we come to, the other standards that you have to be aware of for the level 3 people. This is CR exclusive. Your guys, just on Saturday, Monday rather, we spend the time to look at IFRS 2, share-based payment, IAS 19, employee benefits, and then IFRS 8, segment reporting in that regard. Now, as I told you, you may go to the exam and there's nothing about them. Yeah. There are a lot of standards. Don't take it personal, right? Because that means that you then have to, the examiner is just asking you to do level 2 stuff, which is easier. Just kidding though. But IFRS 2 share-based payment, we discussed those various things. So you make sure that You go into them pretty well. If there is equity settled, how do we determine fair value of share options, fair value of share appreciation rights, you know, fair value of share options at the grant date, fair value of share appreciation right, we use the closing rate. Share options are settled in equity, appreciation rights settled in cash. Share options are recognized under equity, share appreciation rights are recognized under liability. But the movement in either will be recognized in the P&L account. Then we said where there is a transaction and the third party has the right to take either equity or shares, then we are going to apply IAS 32 for the initial measurement because it's a compound financial instrument. Okay, it's a compound financial instrument. And we discussed the way you treat it if it is a supplier and the way you treat it if it is an employee. Again, make sure you know all of these and go over there because those are the advanced things. For the most part, you could deal with share-based payment, share appreciation right. But if the examiner throw you on that tangent, then you got to be careful. If it's an employee, the way we do the splitting, the calculation. If it is a supplier, the way we do the calculation. Please make sure you review that as well because, again, you don't know what the heck the examiner is going to be bringing. Then the deferred tax implication on share-based payment. For tax purposes, we say that the carrying amount is 0. However, we calculate the tax base, which is the number of rights expected to vest, number of employees, multiplied by the intrinsic value. So we use the intrinsic value to do two things: to calculate the tax base if there is a deferred tax implication, or to calculate the payment made to people who exercise their share appreciation right. And so we calculate the tax base, and always share-based payment will lead to deferred tax asset because it's an expenses we are likely to incur in the future, and so the tax authority will reimburse us, so it is a deferred tax asset. But there is a condition there. We said if in a given year the deferred tax asset figure is more than the carrying amount of the tax of the share-based payment based on the calculation, then the excess which result into a deferred tax effect must be recognized in equity, not in P&L. We emphasized on all these. You want to be mindful of that. Then IAS 19, certainly employee benefits, whether we are dealing with deferred contribution or, did I say deferred contribution? Sorry. Defined contribution or defined benefit. Under defined contribution, no P. We just recognize the payment in the P&L account, that's all. But if it is a defined benefit, that the liability is on the entity, the risk is on the entity, any actuary risk arising from the investment and the fund performance is on the entity. So in that case, we recognize plan asset and plan liability. And remember the various items that comes: current service cost, past service cost, interest or investment income. All these will go to the P&L. And if there is any curtailment or settlement during the year, we take them out, and immediately we hear about settlement, we have to calculate gain or loss on the settlement, and that must come also in the P&L account. Again, we emphasize on the way you work in the net environment and also in the individual environment. So make sure that you are familiar with that as well. Then lastly, segment reporting. A segment is simply a part of a business that is generating revenue and incurring costs. Number 2, that has its financial statements reviewed by a chief operating decision maker. And then number 3, certainly we have a discrete financial statement for that segment. But can we prepare separate books of accounts? Number 1, it should meet the definition of a segment report. And then number 2, at least 10% of their revenue or asset should be 10% of the total. Then we can have a discrete or a separate financial statement for that segment. But we said where 2 or more segments, do not meet the minimum threshold, which is 10% of total revenue of the whole company or 10% of total asset of the whole company, then 2 or more segments could be put together if they have the same economic activity, or they are having the same economic activity in that particular case. So those are some of the things also that we must understand when we talk about IFRS 8 segment reporting that you have to be mindful of. Probably one of them will be in the exam, or this is exclusive for corporate reporting students that you need to, understand and be mindful of. Then we come to the other accounting standards that we need to talk about, which is those other ones, IAS. Let me even add this to the basic standards, 7, IAS 36, and his brother, IAS 38. Please, whether I like it or not, you must know these guys. They are baby standards. Impairment. How do you deal with impairment? An asset is impaired when the carrying amount is greater than what? The recoverable amount. If the recoverable amount is greater than the carrying amount, the asset has not suffered an impairment and the entity continues to carry the asset at its carrying amount. Now, how do we determine recoverable amount? Is the higher of value in use and then fair value less cost to sell. How the heck do we get value in use? Value in use is the present value of the pre-tax cash flows from the continuous usage of the asset discounted using the pre-tax cost of capital. That's value in use. Fair value less cost to sell is fair value less cost to sell. Okay, the net realizable value. So you compare the two if they are available in the question, and then boom, you're able to get your recoverable amount. You compare that to the carrying amount. If the recoverable amount is greater than the carrying amount, there is no impairment. The asset is still carried at the carrying amount. But if you compare the two and the carrying amount is more than the recoverable amount, then there is an impairment. And that impairment will be recognized in the profit or loss. However, if we are doing impairment testing for a cash generating unit, which is a whole business or a segment of a business, then we have to be mindful here about the way we treat the impairment. Still, we will calculate the carrying amount of the cash we will have the carrying amount of the cash generating unit. We will determine the recoverable amount of the cash generating unit. Then we'll get our impairment. The allocation of the impairment is where the issue is, because that is where we are going to be looking at the issue in respect of separately identified impaired assets. So in the question, were we told of certain assets that had suffered an impairment? We take them out. Number 2, is there goodwill in the cash generating unit? We write it out. Then from there, we can now allocate the remaining impairment on the remaining assets that are yet to be subjected to impairment, or that are yet to suffer an impairment, and we allocate it. But there is a golden rule there, which we emphasize on during our revision session, that after impairment, the asset cannot be carried below the fair value less cost to sell. You remember that? Those of you who were there or you've watched the playback, you remember. After impairment, an asset cannot be carried below the fair value less cost to sell. So if you finish the impairment and the value of the item or the asset is say 4,000, but the fair value less cost to sell is 4,300, we can't carry the item below the fair value less cost to sell after impairment. So what do? You go replace the 4,000 with the 4,300 so that that excess amount will rather be charged against other assets in the cash generating unit. So that is how we deal with impairment as well. The only thing here is that golden rule. For the most part, at least, my brain is telling me that you're not going to screw me up on the recoverable amount and carrying amount, and then on the allocation. My brain is telling me you won't screw me up. But that golden rule part, that's where my brain is doing me kwane a little. That some people could ignore or not remember that. So please keep that in your mind. After impairment, the asset cannot be carried below its recoverable, below its fair value less cost to sell. And we solved the question in class, and you saw the way we did that treatment. So that is why, if you are paying attention closely, you are looking at the way our revision went and the way we discussed various things, because that is the impulse of these standards. The bare minimum, you can do it, but that extreme, those add-ons, that's where you can be screwed up. Then certainly intangible assets, you know what the heck we are supposed to do there already. I'm not going to talk about IAS 38. Research expenses must be written off. Capital expenditure on research should be capitalized and depreciated over the economic useful life of the asset. Development costs by default should be capitalized if the recognition criteria is met. Sector, separately identified impaired assets. The cost can be estimated reliably. There is a commercial value. It is technically feasible, right? Overall profitability, and there is resource to complete. In the question, you may not see all of them. You can see the cost there, but the deciding factor will be whether there is a market for it, commercial value, and whether the entity has resources to complete. So those will be the two things that you want to see to conclude. If those are not there, then certainly, although it's a development cost, it will be au revoir mes souhaits to the P&L account. So we write it off in the statement of profit or loss account. That is the idea also about that area. Then you come to goodwill. You know this already, right? Only goodwill from acquisition can be recognized in the financial statement, but goodwill arising from, your friend is saying, internally generated goodwill, that cannot be recognized in the financial statement. Then you come to the amortization area. If it has a definite economic useful life, you amortize it over the economic useful life. If it doesn't have, you test for impairment in that case. And you saw the questions that we discussed under this as well during our revision discussion under intangible assets in that particular case. So those are some of the things that we need to also be mindful of in that regard. Again, this is part of the basics. Okay, it's the bare minimum that you can do to be accepted as a financial or corporate reporting student. Also, which of the standard is not bare minimum? They are all bare minimum. Then certainly you come to the other standards that you need to have an idea about, because the examiner could also throw you up IAS 33, earnings per share, IAS 10, events after the reporting period, IAS 2, inventories, IAS 8, accounting policies, changes in accounting estimates and errors, right? IAS 41, agriculture. Okay, all these are other accounting standards that you have to be mindful of as you go into the exam hall. There's plenty accounting standard. How does the examiner expect us to learn all of this accounting standard? How are you expecting yourself to be called a chartered accountant if you can't learn this? It's possible. All right? It's possible. And by now you have learned all these things for the most part if you're a serious student. Right now it's for cruising, right? It's not like like you're not going to stay just cruising. Like, but it's like just cross your leg and you just grab a cup of tea and you're just sipping tea. And okay, if you have an iPad, you're just flipping. If you have your summary notes, you're just flipping through. That's the swag this time. That's why from here you have to go and freshen up and sleep. Tomorrow morning you get up, it's a good breakfast. Get to the exam hall on time. It's swag. Some of you, mining. If I talk right now, go and say something. So these are the standard issues that we need to understand there when it comes to dealing with this. Also, we can't sleep. Oh. Why? Why? There is no sleep for evil man. So are you evil? Remember, at this point, there is no sleep for evil man. Why can't you sleep? Sleep. If you have learned, by this time it's for cruising. So just sleep, chill, relax, let your brain work. Oh, mommy. See, if you sleep well, tomorrow morning, your brain will be relaxed. You see that the apple will just be coming, will just be coming, will just be coming, will just be coming. Unless you've not studied that one there, then don't sleep. But you have to sleep. Rubaba, when you finish, go and sleep. Nothing will happen. Yes, Joseph, your hand is up.
Yes, sir. Please, about the corporate governance and that of the sustainability development. I still do not I'm not able to get it. So I don't know if you can be of help to me, so I'll get it on
I
time
told you
then
can send a message on WhatsApp about that.
I've done that several times.
When?
About 30 minutes ago.
30 minutes ago today, my assistant is not available. So I will have to check that and confirm from her before. So
I bought 2 books from you. That the public sector accounting
so
and that
don't
of
worry.
reporting.
If I go off this stream, I'll check it and see. If
somebody's panicking.
You are panicking by this time. Why should you panic? Baco, you are panicking. Who asked you to go and panic? You this boy. Also, let's exchange shoes. Why? Who? Jefta. You want to exchange shoes with who? Me? Or who? Who do you want to exchange shoes with? Me? Or who? Sleep, please. It's very important. Because you see, after learning, after the stress, your brain has to rest. And when you sleep and wake, you sleep very well and you wake up, your brain is sharp. I know you won't believe it because you've not experienced. Your brain will be sharp. If you like, try it. If you have not studied, please, then go and continue your mining, but that is stress. I said, trade my shoes. I don't think I can fit in your shoes, Jefta. Your shoe will be bigger than my shoes. My feet is small. Your shoe will be bigger. All right? You were to be in our shoes, wouldn't you talk about... No, I will sleep. Share. I will sleep. Like, by this time, like I was saying, by this time, you shouldn't be learning. If right now, Paco, you are really learning, I don't know. Per best practice, by this time is for chilling. That's what I was telling you. Like, by this time, you are sipping some, fruit juice, what did I say? What cross or 9B, nah? You're just, there is this word. I've forgotten the word. But you are just, enjoying the atmosphere. No pressure. We wear the same. We don't wear the same shoe. Go with you. So these are the standards that you have to be mindful of in that particular case. So I don't know. As you sit down, you should know 90% of these standards off head. The question is, do you? And that is where probably some people will start panicking. But panicking is not the best medicine. At this time, you shouldn't panic. Because when you start panicking, your brain is not going to work. Everything else you've learned will just go out of your brain. So please, no matter what happens, no matter where you are at now, do not panic. Because some of you, maybe throughout this session that we are doing, you realize that, holy cow, there is a lot of gazillion issues that you hadn't looked at. Now you're going to panic. But I'm begging you, do not panic. Because I'm saying this politely, okay? On a light note as well. If you have been serious for the last 12 weeks, you wouldn't be here now. So it's your own doing. Are you getting it? It's your own doing. So maybe you are in that position, you are like, how the heck is Nhyira able to walk through all of these standards with me? And it looks like I don't know a lot of them. What do I do? Don't panic. From here, bath and sleep. Get up tomorrow morning, do what you have to do, go to the exam hall. If you were serious from session 1 to now, by this time you'll be sipping tea. But now you have to panic. So please calm down. I don't want you to panic, because if you do, it will affect other things that you have already learned. When you are panicking, nothing sticks. It hurts you more. So relax. If it's coming, just tell it. All is well. Okay? Like the Three Idiots movie, if you have watched it before. Just say, all is well. All is well. All is well. All is well. Calm yourself down. Okay? Calm yourself down. You'll be good. That psychology part is very important. I've already told you this during our class. So these are the standards that, we got to be mindful of. 70%, because it's going to be cutting across everywhere. Ratios, you may call on standards. Conso, you will call on standards. There will be standard-related questions themselves also. You have to call on them. Are you getting it? So, please, I don't know. Where are you? Frankly speaking, what do you think is your average position? Like, how many percentage you are at? Don't answer it. Just answer it yourself. Like, don't tell me. Just answer it yourself. Where do you see yourself? Because if 70% of the questions you have to apply standards, then you know the outcome. Okay? But you have a lot of time to go. I'm going to wrap up in a moment, and some of you will start learning from now till thy kingdom come tomorrow morning. All right? So please, I don't want you to panic. All right? Adie idie, nyame o. Hey, Gerard, why? Nyame di obebem, but there's only usua adie no. Gerard. Nyame di eba di obeba. Why? Bapa di obeba. But there's only ntobas here. Felix said what? Warning. The question is not your partner, so don't obsess over it. Leave it, move on, and come back later if you still have time. Oh yes, I mentioned this as well, because some of the questions you think you can solve them and you cannot. So you just leave it and go to something else you can do generally. That is why the strategy is read all the questions, take out the theories you can do. From there you can come to the ratios, come to the standards or specialized transaction and all those things, and it should be good. Okay? It should be good, really. Okay. It's already 9, so I'm thinking of wrapping up really quick in that particular case. Let me talk quickly about these last two things, then we go. Specialized transaction, then I'll come to consolidation quickly. Specialized transaction for CR students exclusively. There are two things here, as you know already. Financial reconstruction and then business valuation. In that case, under the business valuation, the formulas, you don't have problem with them. But it is the adjustment, which will be based on the accounting standards. That's where the problem is, right? And so we've addressed and spoke about the various things that you need to be mindful of based on the context of the question. Based on the context of the question. Based on the context of the question. Under financial reconstruction, we've given guidelines on the various things that you are expected to do. Generally, when it comes to financial reconstruction, if we are liquidating, the liquidation sharing schedule, please make sure you go over that again. The way we deal with fixed charge and floating charge secure debts, right? And then when you finish the write-up for the analysis, make sure you look at that. Then under reconstruction, Capital reduction account will be prepared anyway, which will be the same as maximum loss or gain if the examiner wants us to do maximum loss or gain in that particular case. So you calculate that. Then based on the context of the question, you work. One thing that I've seen is that when it comes to the reconstruction part, there is no formula. Like, it depends on the question. So you just have to read as you go, read and work, and make sure you are like your grammar is good. Because it's an English paper, and it goes to everybody. Because if you read the grammar, you don't read the grammar well, bro, you toasted. So sometimes understanding the question is part of answering the question. So if the grammar there, you don't understand it, and it's not because you have not gone to school, but in Sisiso, like they say, oh, something has been reduced by. That is different from something has been reduced to. Okay, reduced by, the treatment is different from reduced to. So if by and to, you don't interpret them well, au revoir mon ami, zok pokpokpo already. So that's what I would say there, paying attention to the context of the questions and knowing the various adjustment that has to be made generally in that particular case under the reconstruction as well in that regard. Again, like I said, although last semester there was reconstruction, that doesn't mean that this semester there will be business valuation. The examiner can still repeat reconstruction. He is not under obligation to explain to you his agenda. So you have to still know the two as we discussed during our revision session to crystallize on them and understand the principles. When you hit there tomorrow, whatever that is there, you make sure you take your time and work on them in that particular case. Then certainly question 1, which, as I said, per best practice, I want you to attempt this as the last one, or last but one question, and you are going for the easy marks. Goodwill calculation. Please, I beseech you, brethren, that you review the goodwill calculation. Please. No matter what happens, at least you have to calculate the goodwill. At least, and get it well. Especially, the fair value of consideration transferred. Some of you, treatment of the share exchange is a problem. Deferred consideration is a problem. So make sure you understand the calculation of the fair value of consideration transferred. Then for corporate reporting students, subsidiary. Goodwill calculation in subsidiary. You will take the controlling interest or the parent ownership in the subsidiary of the money the subsidiary paid the subsidiary. That is the fair value of consideration transferred when you are calculating goodwill in the subsidiary. Very important. Then net asset at acquisition. Some of you, you know your problem there. That net asset acquisition, you can screw it up well. But we've dealt with all of them. So please, crystallize on that. Know how to calculate retained earnings at acquisition when it is not given. Then intragroup trading. Then non-controlling interest. Then investment in associate. At this point, it's a lot. That's all about my discussion. I've ended. That's all I can do for you in that particular case. And these are some of the things that I can say generally in that regard. And if you check well, you realize that really, if you have been studying, none of these should be a problem. Like, it's fun, right? You see the way I went through the ratios, we came to the standards. You see the way I was talking about the principles. Like, if you have been studying, like, a bit chisa like that for you. So I'm done. My last takeaway is what I told you in the individual class. Read through the questions well, okay? And then, let me see if I can bring that slide up. FR, final session. Here. Okay, let me just repeat that. Read through the questions well. I beseech you that you answer all the written questions first. It's 20 marks. Answer all of them as fast as possible. From there, you can choose what you want to do, the ratio, so the specialized transaction or single entity, or the standard, so conso, you are going there as your last or last but one question. Again, that's just my recommendation. If you get to the exam hall and something comes over you, that the console should be the first question you should solve, or you have some malam somewhere, or prophet somewhere that says, if you go answer question one first, please don't disrespect the malam or the bishop. Okay, I'm just a mortal man. I don't see in the realms of the spirit. So when you get to the exam or whatever you have agenda of, please go ahead with that. Okay, I am just giving you the best practice. Take out the theories, do the ratios. If per the analysis document we've shared, you've mastered the act, there is no ratio questions you cannot deal with, then you can go to the standards, you can go to the specialized transactions. So by the time consolidation is going to bother you about how can I calculate net assets at acquisition, hey, this fair value measurement figure, how do I treat it, hey, should I bring it both at acquisition and at the reporting date? By the time you are meditating on all those things and wasting time, there are some questions that you could have used to solve. And nothing I may say, let your console be your last or last but one question. And you are not in a hurry to go and extract any financial statement, because I've told you, the examiner doesn't mark what you have put in bracket. On the face of the financial statement, what the examiner marks is the figure under the cash column, not what you have put in the bracket. So you are not in a hurry to go and extract any financial statement. Take it easy. Slow down and do the workings as we have done in the various questions in consolidation that we have solved. Just do your workings. Get your goodwill. There is a marks there waiting for you on goodwill, between 2 to 5 marks depending on the context of the question. There may be a question in the exam where the A aspect will say calculate goodwill at acquisition, 5 marks. Then the B part will be prepare consolidated profit or loss, or consolidated statement of financial position. So you have between 2 to 5 marks for goodwill. And you can get that pretty easily. Pretty easily. So please, best practice, follow this. By the grace of God, we've done what we have to do. And it is our prayers, really, really sincerely, that as you go there, the grace of God will come over you and you'll be able to remember, work with speed and accuracy, have a stable emotion and a great state of mind, so that you can write the exam with confidence and, most importantly, be able to pass the examination. Because as I said, if your emotion is imbalanced, you are panicking, you are shouting, you are moving A to B, you're going to be toasted. Calm down. Just tell yourself all is well. Just tell yourself all is well. I can do all things through Christ who strengthens me. I am the child of God. I am the called of God. The Lord has not given me the spirit of fear or doubt, but He has given me the spirit of sound mind and faith. I am the child of God. I will win this one. Talk to yourself positively. Then you learn. Because some of you think it's just about kabe, kaya, kabo, without learning. You learn, then you do kabe, kaba, a mix. You're untouchable. So that is the idea about that. I'm going to be wrapping up around here. Really today for the discussion, generally in that particular case. Any other questions for me? I don't know. What do I have? People are just laughing at me in my chat. Can you imagine this? You people are just laughing at me in my chat. Okay. What do I have? Let's see. I want to see if there is any chat I have to deal with. Okay. I think I said that this laughter there somewhere on YouTube. All right, so that's it about that, and we wish you all the best, right? All the best as you are going into the exam hall. Really, really wish you all the best, and I'm still on standby. I'm on standby, right? It's not like I'm gonna sleep really, so I'll be on standby. I'll sleep, but I'll also be on standby. My phone will be near me or will be closer to me. So if there is anything you want to pick my brain on, not like you want to pick my brain or something you want to see clarity on, you can send a message about that and you'll be assisted in that particular case. All right? So until then, from now to 9 a.m., 8 a.m., 9 a.m., if you call me, the phone, it won't ring. It won't come. So don't bother. Oh, how about corporate reporting students? Send a message if you're a corporate reporting student. I don't want any trouble. There was a time somebody was in an exam hall and was sending me things. Ushe me nimi ya. Na me da graphic enim. Oh, Nhyira Premium. Engaging in examination or practices for how? For what? Money. Look at him. Want to give me trouble. So by 8 a.m., that one I'm off. But you can send a message about before then and you'll be assisted. All right? So that's it about that. All the best. As I said, before the exam, you can reach out if there is anything that you want to pick my brain on. As I said, don't send me a question to solve for you. That I won't do at this time. But if there is something you don't understand or you want to seek clarity on, by all means, you can reach over or you can reach me and I'll be assisting you. All right? So please relax, sleep, go and freshen up and sleep. Shrinsi. Oda shrinsi. Shrimba. So sleep. Get up tomorrow morning, refresh. Eat your best breakfast tomorrow morning. Be fed. Okay? If you are somebody who takes trotro, tomorrow dear, don't take trotro. Okay? Be fed and go to the exam hall on time. Treat yourself keenly or queenly tomorrow. So you have a good emotion before the exam. Sika openo de. How much is Uber from your house to the exam center? You jump from one trotro to another, be in queues, then the trotro is stopping. You are in queues, then you start panicking. Spend the money on yourself tomorrow and the whole of this week and be nice. Enjoy yourself. Wishing you all the best, and we'll see you some other time in other subjects. Those of you who are graduating too, we'll see you on your graduation day. Au revoir.